Welcome, everyone. Let's get started. Today, we are diving into the architecture of corporate cash, optimal account operational approaches. A company's bank account structure dictates its financial efficiency. Let us master how to build it. Let's begin with the absolute foundation. What is an account operational approach? Think of it as the plumbing of your corporate finance house. It is the strategic design and organization of all your global bank accounts. The basics involve deciding where an account should be located, in what currency, who owns it, and how it connects to your systems. Why is this critical? Because if you get this wrong, you suffer from trapped cash, massive bank fees, and poor visibility. It's like having a leaky pipe where value simply drips away. How do we design it? We look closely at the business model, the transaction volumes, and the local regulations. In our deep dive, I want you to remember that account structures are incredibly sticky. Once you hard-code a bank account into your enterprise resource planning or ERP system, changing it requires a massive IT project. Therefore, getting the design right on day one is paramount. Look at the flowchart on your screen. This represents the three-phase lifecycle of account structure design. We always start at the top with Phase 1, needs analysis, which is driven by your business model and cash flows. Once we know what we need, we move down to Phase 2, bank selection, evaluating partners based on coverage, pricing, and technology. Finally, we reach Phase 3, implementation and integration, where the accounts are hardwired into your ERP and Treasury management systems. You must follow this linear path. Skipping straight to opening accounts without a needs analysis is a recipe for operational disaster. Moving to our second slide, we encounter the biggest dilemma a treasurer faces when designing accounts, the trade-off between flows and liquidity. What is this? It's a strategic choice. Are we optimizing for the speed of transactions or the pooling of cash? The basics are simple. If you want effective flows, you open accounts with local domestic banks to pay local vendors quickly. But if you want efficient liquidity, you use a few global banks so you can pool all your cash together. Why is this a trade-off? Because using 50 different local banks fragments your cash, making it impossible to pool efficiently. How do we decide? We assess the business need. Does the local subsidiary absolutely need same-day local clearing, or is minimizing external corporate debt more critical? In our deep dive, history teaches us a harsh lesson. During financial crises, such as 2008, treasurers instantly abandon flow prioritization and aggressively restructure their accounts to centralize liquidity. Cash is king when markets freeze. This decision tree maps out the core drivers of account structure. Starting at the top diamond, the Treasury priority splits into two distinct paths. If you follow the left path to effective flows, it dictates a structure of many domestic banks and on-site local accounts, ending in high transaction efficiency. Conversely, the right path focuses on efficient liquidity, leading to fewer global banks and centralized Treasury accounts, which culminates in maximized cash concentration. As an architect of Treasury, you must consciously choose which path aligns best with your Chief Financial Officer's current strategic mandate. Let's explore our first basic operational approach, local accounts with local control. What is it? This is the highly decentralized model typical of younger or aggressively expanding companies. Local subsidiaries open, own, and operate their bank accounts in their own country. The basics are that local finance teams handle all daily receipts, payments, and bank relationships. Why do companies do this? Because it offers maximum operational flexibility. The local team speaks the language, knows the local clearing rules, and can react to local vendor needs instantly. How is it governed? The global treasury usually just issues a broad policy manual, leaving the actual execution to the local CFO. But here is our deep dive. While this is highly agile for the local sales team, it is a nightmare for the global treasurer. This structure destroys group-wide cash visibility. You end up with a scenario where your Asian subsidiary is borrowing at 8% interest, while your European subsidiary has millions sitting idle in a checking account earning zero. It is fundamentally inefficient for liquidity. Look at this diagram depicting the decentralized approach. At the top, the Global Treasury Center connects to Subsidiary A and Subsidiary B using only dotted lines. This represents that HQ merely issues policy. There is no direct operational control. The solid lines show that Subsidiary A has full, independent control over its local European bank, and Subsidiary B has full control over its local Asian bank. They operate in complete silos. There is no horizontal connection between the banks, visually confirming why cash becomes trapped and invisible to the central group. Moving up the maturity curve, we reach approach 2, centralized accounts with local control. What does this mean? In this model, the physical location of the bank account is moved to a central hub, but the operational control remains with the local subsidiary. For the basics, imagine a company where all US dollar accounts, regardless of whether the subsidiary is in Japan, Brazil, or Germany, are domiciled in a single bank branch in New York. Why take this approach? By putting all USD in New York and all euros in London, you naturally concentrate your currencies. It makes setting up cash pools exponentially easier. How does it work operationally? The subsidiaries log into a global electronic banking portal to initiate payments from their New York account. However, our deep dive reveals significant friction. While you solve the trapped cash problem, you create operational headaches. If a Japanese subsidiary needs to resolve a payment issue on a New York account, they face a 13-hour time zone mismatch. Additionally, paying a local Japanese vendor from a New York account introduces cross-border correspondent banking fees and delays. This chart illustrates the hybrid nature of approach 2. On the left, subsidiary A in Japan and subsidiary B in Germany are using dotted lines to remotely operate a single node, the central USD account in New York. The physical cash is centrally located. From that New York account, a solid line feeds directly down into a global USD cash pool. This visual perfectly captures the benefit. The subsidiaries maintain their operational independence to pay their bills, but the central treasury instantly benefits from the concentrated liquidity because all the funds reside in the exact same jurisdiction. Now we arrive at the apex of account operational design, approach 3, where Treasury completely controls centralized accounts. What is this? This is the ultimate, fully integrated model. Global Treasury dictates the location, owns the legal mandate, and fully operates the accounts. The basics usually manifest as an in-house bank or IHB. The subsidiaries do not even have external bank accounts anymore. They hold virtual accounts with the corporate treasury. Why is this the gold standard? It delivers 100% cash visibility, eliminates redundant bank fees, and allows the company to fund itself internally, slashing external debt. How is it executed? Through structures like POBO, payments on behalf of. When a subsidiary needs to pay a vendor, Treasury makes the payment from a single master account on their behalf. Our deep dive shows the true elegance of this design. Subsidiaries stop interfacing with banks entirely. If sub A owes sub B money, no cash moves through the banking system. Treasury simply debits one virtual account and credits the other. It is pure financial efficiency. Observe the in-house bank structure on your screen. The subsidiaries are at the top, but notice their arrows only go to the yellow in-house bank node in the middle. They are completely cut off from the external world. The in-house bank acts as the supreme control tower. It receives their internal requests and then, using a solid line, executes the payments via a single master global bank account at the bottom. The master account then pays the external vendors. This structure bottlenecks all corporate cash through one highly controlled, highly visible gateway, representing the pinnacle of Treasury design. To truly master account operations, we must take a deep dive into the legal status of the accounts themselves, resident versus non-resident accounts. What does this mean? It refers to whether your corporate entity is legally domiciled in the same country as the bank account. The basics: if a U.S. parent company opens an account directly in India without an Indian subsidiary, that is a non-resident account. Why does this matter? Because governments treat foreign money differently. You must navigate strict exchange controls, withholding taxes, and central bank reporting. How do you manage it? You structure the legal ownership of the account to optimize your tax footprint and ensure you can legally repatriate the funds back to your home country. In our deep dive, operating non-resident accounts in emerging markets is incredibly complex. Countries like China or Brazil have strict capital controls. You cannot simply wire money out of a non-resident account. You often have to provide the local central bank with physical invoices and customs declarations to prove the transaction is tied to legitimate trade, not currency speculation. Ignorance of these rules leads to frozen funds. This flow diagram highlights the divergence in regulatory treatment based on entity domicile. Starting on the left, the account strategy hits the entity domicile decision point. If the entity is in country, it opens a resident account, which flows easily into standard local clearing. However, if the entity is overseas, it opens a non-resident account. Look at the multiple complex outcomes this triggers: central bank scrutiny, withholding tax impacts, and strict repatriation controls. This visual warns the Treasury architect that cross-border account structures require heavy legal and tax due diligence before implementation. Let us look at a highly critical, real-time use case, account rationalization at the Global Growing Group, or GGG. The scenario, GGG expanded aggressively through global mergers and acquisitions. Because they let every acquired company keep its own banks, they ended up with over 1,600 fragmented bank accounts spread across 150 different local banks. The problem was catastrophic. They were losing millions in redundant maintenance fees, the CFO had zero visibility on regional cash, and they were exposed to unmanaged FX risks. The solution? The treasurer initiated a massive account rationalization project to migrate to a regional treasury center. The execution was ruthless but necessary. They closed 1,200 redundant accounts. They fired 140 local banks and appointed just 3 lead global banking partners. They then implemented automated zero-balance sweeps on the remaining accounts. The result, by simply cleaning up the account structure, they saved over $500,000 annually in bank fees alone. More importantly, they unlocked millions in previously trapped cash, which they immediately used to pay down their expensive acquisition debt. This process map shows the turnaround of GGG. In the red box at the top, we start with the crisis state, 1,600 plus accounts and 150 banks. This flows into an audit and needs analysis. The strategy then splits into 2 simultaneous actions, closing 1,200 redundant accounts and appointing 3 global lead banks. These dual actions converge into the creation of a centralized account structure. Ultimately, this hard work flows into the green box at the bottom, the phenomenal result of $500,000 saved and enterprise debt significantly reduced. It is the perfect validation of optimal account design. In our final slide, we address the technology that makes modern account operations possible, EBM and APIs. What is EBM? It stands for Electronic Bank Account Management. It is the digital lifecycle management of your bank accounts. The basics involve replacing archaic, paper-based bank mandates and wet ink signature cards with secure, automated software workflows. Why is this mandatory today? Because if you have 400 accounts, tracking who is authorized to sign a check manually is impossible. When a CFO leaves the company, manually updating 400 paper mandates takes months, creating a massive fraud risk. How do we fix this? By using Swift ISO 20022 messaging or REST APIs to talk directly to the bank servers. Look at the sample JSON code on your screen. This is a simple API POST request to automatically provision a new Euro account and assign 2 specific digital signatories instantly. In our deep dive, a modern treasury management system uses these APIs to ensure 100% compliance. When an executive's profile is deactivated in the HR system, the TMS automatically pings the bank APIs to instantly revoke their signing authority globally. Thank you for joining me. To master these concepts, I invite you to like, subscribe, and visit quicktechie.com for premium certification prep, including comprehensive Q&A banks, full ebooks, audiobooks, full-length training, and interview guides. This final architecture diagram illustrates the power of API-driven account management. On the left, your treasury management system initiates a JSON or API request. It hits the central node, the global bank gateway. From there, the bank servers instantly execute commands without human intervention, whether it is auto-provisioning to open a new account, a mandate update to revoke a signatory, or a status fetch to grab a real-time balance. All of these automated actions culminate on the right in 100% digital compliance. It represents the ultimate fusion of corporate finance and modern technology.